In this episode, we are going to discuss below market interest loans. This is where a dad gives a loan to a son to be able to do something. But he says, oh, don't worry about it. You don't have to pay any interest. We're just going to call this a loan so that I can take a benefit for it tax-wise. Well, that was shot down recently, and so we're going to go over in more detail how that works. So let's get started. So the first thing that we have to do is we have to discuss what the recognition principle is. Recognition is, when do I recognize income for tax purposes? It's the difference between when it is realized, when you realize income into your books, also depends on if it is recognized as a taxable event. And so realization only occurs when the taxpayer performs services or sells goods, thus becoming entitled to a payment from another party. But then it follows that no income is realized if the goods or services are provided at no charge, right? So in the example that I gave at the very beginning, when dad gives a loan to son, no income has been realized by dad, therefore he gets a better tax benefit, right? Well, this was the rule prior to 1984, where interest-free loans were used to shift income between taxpayers, and this is typically done between parents and children. So let's go over an example. Chris, who is dad, is in the 50% combined federal and state tax brackets, and Vincent, his son, is in the 20% marginal tax bracket. Chris has $400,000 that he does not need, and Vincent could use the income from Chris's extra cash. So Chris transfers the $400,000 to Vincent in exchange for a non-interest-bearing demand note. Assume the applicable federal rate of interest is 3.5% through June 30th and 4% from July 1st through December 31st. Chris made the loan on January 1st, and the loan is still outstanding on December 31st. So the question is, what are the tax consequences? Well, before 1984, Chris could transfer the cash to Vincent in exchange for a non-interest-bearing demand note. Vincent could then invest the cash, and the income would be taxed at his 20% tax rate. Thus, the income that Chris could have earned on the $400,000 and that could be taxed at 50% became Vincent's income, taxed at 20%. Additionally, Chris retained control over the principal because he could demand the payment back on the note at any time. So now that it's 2018, Chris must recognize interest in the amount as follows. So from January 1st through June 30th, we have an amount that we have to calculate of interest, where we multiply the 3.5% by the $400,000, and then we have to multiply that by 1/2, because he's only incurring interest for 1/2 of the year, and that is $7,000. Okay, but then we have to calculate the second half of the year at 4%, so this is through July 1st through December 31st, and we multiply that 4% by the $400,000. But because interest was accrued of $7,000, we have to include that as part of the computation. Multiply that by 1/2 of the year, because we're not calculating for the full year, and that gives us $8,140. The total amount of interest income that Chris needs to include on his tax return is $15,140. So you're saying, well, wait a second. But what about Vincent? Well, so even though Vincent invested this loan as follows, the interest that he earns is treated as an interest expense and not taxed to Vincent. Instead, it's taxed to Chris. And so Chris is actually deemed to have given this $15,000 as a gift to Vincent. And gifts are not taxable to the individual receiving the gift. Okay, so this happens all the time. Parents are constantly giving gifts to their children, whether that be that they want to not have that income included in their tax return, like in the example that we just discussed, or let's say mom gives a loan to child to be able to buy a house, but then doesn't accept any interest as a part of that loan so that that house can be bought. Well, these are the types of situations that Congress is trying to avoid, because child may not be in as high as of a tax bracket as mom or dad are, and therefore they're trying to create or get that money back that's being attempted to be funneled out. Okay, so now let's talk about imputed interest and how it's calculated. So I brought up this AFR, or the applicable federal rate. The applicable federal rate is compounded semi-annually and is adjusted monthly and published by the IRS. We've got three different rates. We've got short-term, we've got mid-term, and we've got long-term. Less than 3 years, 3 to 9 years, and 9 or more years. So now let's go to an example. Let's assume the same facts that we just went over in the previous example, except that Chris charges 3% interest compounded annually. What do we know here? It's a below market interest rate, and therefore we've got the same issues that we talked about earlier about recognition. So in this situation, we take the $15,140 that was computed in the previous example, and then we take the 3% interest, which we're going to calculate backwards, of 0.3 times the 400,000 that is compounded semi-annually, and that gives us interest of $12,000. Now that $12,000 is being calculated on Chris's tax return, so therefore we need to figure out how much of his son Vincent's interest actually should now be put back into his tax return and taxed at his rates. And so we take that $12,000, subtract it from the $15,140, and we're left with $3,140 that has to be put on Chris's tax return as additional interest. Now here are a list of several below market loans where the imputed interest rules apply. These include gift loans, so when a parent gifts money to a child but they're treating it as a loan and therefore you've got 0% interest. We've got compensation related loans. If a corporation is paying an employee and the employee says, I just need a loan, and so they give a loan with 0% interest, well, the corporation or the entity then needs to pay tax on that imputed interest. Corporation shareholder loans, tax avoidance loans, and any other loan that significantly affects the borrower or lender's federal tax liability. There are some exceptions to the imputed interest rules. These are gift loans of $100,000 or less between individuals, but not if used for producing income. And it also applies to compensation and corporate loans if there is no tax avoidance motive. So these amounts are considered an immaterial amount. Also, loans between individuals of $100,000 or less. Here, the imputed interest cannot exceed the borrower's net investment income for the year. Or, stated another way, the income imputed cannot exceed the borrower's net investment income. If the borrower's net investment income for the year does not exceed $1,000, then no interest is imputed on loans of $100,000 or less, unless there is a tax avoidance motive. Let's go over one more example where mom makes an interest-free loan of $300,000 to child to buy a house when the applicable federal rate is $8,000. What are the tax consequences? Well, we go through the exceptions. Was a gift loan of $10,000 or less made between individuals? No, we've got $300,000. So is this a loan between individuals of $100,000 or less? No, again, that exception doesn't apply. How about if the borrower's net investment income for the year does not exceed $1,000, no interest is imputed on loans of $100,000 or less. Well, again, we're not dealing with a $100,000 or less loan, so therefore none of the exceptions apply. No exceptions. And therefore we have to calculate the imputed interest. So the first thing that I do is I take since it's compounded semi-annually, we take the interest rate of 8% and we multiply that by the $300,000 loan. Not quite, because it's semi-annually compounded. So then this gives us an amount of $12,000 that is imputed for the first half of the year. Then we have to take the 0.08%, multiply that by 300,000 plus the 12,000, and because it's also compounded semi-annually, we then get an amount of $12,480 of interest for the second half of the year. So for the first half of the year, for the first year, mom is going to be imputed interest income of $24,480. Mom will be taxed on that $24,480 of taxable income if child had to pay it. Mom will also be deemed to have made a gift. So this is interest income to mom. And mom gave a gift of that $24,480 to child. And child will be deemed to have paid the interest to dad and will be allowed an interest deduction on his or her tax return if that is allowable. All right, so that is below market loans or imputed interest. If you have any questions, feel free to leave a comment in the comment box below, or you can write an email to centerfortaxstudies@gmail.com. Thanks for watching, and subscribe for more of these videos. Until next time, have a good tax season.